Hello, and welcome to week one, sort of a background week to look at some of the foundational truths of accounting. We're going to look at this particular textbook, so you might want to get that handy. It's not really a textbook, kind of thin for that. You should have already read this, takes about an hour, very basic instructions on debits and credits, normal balances and T accounts. So if you think, well, I'm a manager, I don't really need to understand that detail of accounting, but you will find that if you understand that, it makes a lot more sense about what you're looking at when you're looking at a balance sheet, when you're looking at an income statement and seeing how those two fit together. So first of all, let me share a couple of PDFs that are out there. Let's see here. Yeah, under table of contents here in D2L, you got the syllabus, which we went over last time. We got this accounting principles and accounting cycle that we're going to look at here in this first week. This other one down here, leadership challenges, that's sort of the capstone assignment for this course that we'll go back and look at later on, not the first week. But accounting principles, let me download that file here. And pull that up, and hopefully that's still showing as being shared. Yep. What you have here are 12 guidelines and principles that are very important for us to understand as financial, well, not just financial people, operational leaders. To understand the financials and what goes into developing your financial statements. Your statement of financial position, which is another term for your balance sheet, as well as your income statement. Some of these are very basic. Economic entity assumption. You got to keep your business transactions separate from personal, which that sometimes can be an issue when you're a small company. Your larger companies, that's not an issue. Monetary unit, we use dollars in this country, obviously. Time period assumption. Most companies close their books on a monthly basis. Quarterly, if you're required to, if you're a publicly traded company, you're also required to have quarterly statements, as well as annual, which is your 12 months. But there's a time period assumption there. Going concern, very important to understand that if you're a going concern, especially those in financial positions of financial leadership, now you make some of your transactions that impact your balance sheet. Measurement is cost principle. What was the historical cost? Fair value is something that's come along in the last several years, that there are market-based measures that you will change the value of an investment on your books or a liability on your books based on fair value, like investment in stocks or investment in bonds. That's something that's changed from when I went through college. So that's something to consider as well. Full disclosure. A lot of disclosures go on in your financial statements. Again, I'm just hitting the high spots here. But what's most important, and we've got 3 case studies. 3 of those 7 are based on revenue recognition, the matching principle, and materiality. So what's revenue recognition? That drives your entire accounting process, your financial system, your operations, because all these things are tied together between operations and financials. Revenue recognition is the set rules and procedures for when do you recognize revenue. When the performance obligations are met, obviously title passing from one entity to another. So revenue recognition, and that's really probably the most, where most fraudulent activity occurs, is in revenue recognition. So it's very important. And then the second part of this is your matching principle. Well, you're recognizing revenue, then you're matching expenses with that. That's 95% of what accountants do, is matching expenses with the revenues. And this is accrual basis, A-C-C-R-U-A-L, accrual basis accounting. You probably heard that term before. All right, A-C-C-R-U-A-L. not cash basis. Cash basis is what the IRS operates under. Accrual, not cash basis. What's the accrual basis of accounting? It doesn't matter when you receive the cash for your revenue. That's what accounts receivable is. It's when did you make the sale? When were the performance obligations met? That's the accrual basis of accounting, as well as with expense. It's not when you pay the bill, because you can pay your bill 30 days later, 60 days later, 90 days later. But the expense is recorded when you receive those goods or the services rendered for you, right? If you bring somebody in that works on your heating and cooling system, if they did that work on the 31st of the month, then you recognize that expense in that month, not when you receive the invoice. It's when are the goods delivered to your docks in the case of equipment or supplies. But if somebody's doing work for you as well, a service company, it's when did they do the work? That's when you record the expense. So it's all about the accrual basis of accounting. Very important. Very few companies operate on a cash basis, except the IRS. All right, let me go back and share that screen again. Revenue matching, again, we got a couple of cases on that we'll work through together. Materiality, what is materiality? Well, materiality says, is a $50 invoice that important to a company that's got $3 billion a year in revenue? And the answer is no. As a controller at Exide, when we were closing the books every month, we had a threshold of $500. If it was an invoice or something, goods delivered that was $500 or less, $499 or less, we didn't care about that. So we didn't have time, first of all, to go through and make sure all of these deliveries were on our books. I mean, a lot of it's automated, but at the same time, you might have something $300 or $400 that's not been received onto your books through your software, through your SAP or JD Edwards system. But materiality just says, is it worth the effort? Another great example is capital budgeting, capital expenditures. I know a lot of you, that something that you work on at your place of business. Most companies have a policy that if it's $2,000 or less, then something that you purchase that, even though it has a useful life or economic life more than a year, because that's usually the threshold is 1 year. If it's got a useful life longer than that, then you should make it a capital project, put it on your books as an asset, and then depreciate it. Well, you don't do that for a $3 calculator. You don't even do it for a $1,000, whatever it might be. It might be a laptop or an iPad. Doesn't mean you're not going to track it and trace that to make sure it doesn't get stolen or lost, but it's not going to go on your books as an asset to be depreciated, because materiality says we're going to have a threshold of $2,000 and above is what's going to be capitalized. And being capitalized means it's going to be depreciated. All right, what about, we'll get into all of these in more detail later. What about conservatism? We want to err on the side of what? Understating revenue and overstating expense. You don't want to do either one of those, but you definitely don't want to overstate revenue or understate expense. I mean, there's guidelines for that accountants need to follow, but you as potentially the general manager or president of the company, you need to know what's going on with these various principles. And conservatism, you need to be conservative. You don't want to mislead your investors, your stakeholders, your creditors. And then finally, number 12, so important, consistency. Oftentimes you think, well, how should I put this on my books, or do I even need to record it on my books? Do I just need to disclose it? But consistency says, well, what did you do last time in a similar situation? And maybe you've got a situation that is new and unusual. That's when you need to engage your public accounting firm for advice. If they're the ones auditing your books once a year, get them involved so you make a joint decision that is within GAAP. So all of these are generally accepted accounting principles. You may have heard that term GAAP, G-A-A-P. Another key term, GAAP. GAAP, Generally Accepted Accounting Principles. Now, if you go overseas, if you're a publicly traded company overseas, they use what's called IFRS, International Financial Reporting Standards. I believe is what it stands for, IFRS, internationally. But here in the United States, it's GAAP, GAAP. What's GAAP? You throw that term around in a meeting and you're a non-financial person, you're going to win the hearts and souls of all your financial people. So very important. Let's see here. Back to accounting principles and guidelines. Let me download something else here. The accounting cycle. This is something I use in principles, but it's worth talking about again here for just a few moments. Let me see if I'm sharing that. Yep. In fact, it's rather old, 6 years old now. It's when I started teaching full-time here at ETSU, fall of 2014. But what I've got here is a one-page snapshot of the accounting cycle. Hard to get everything on one page, but this is a good foundation before we get into this Accounting Made Simple book. So there are three statements: an income statement, balance sheet, and statement of cash flows. But there's really just two types of statements that are the essence of your company, and it's the income statement, it's the balance sheet. The income statement, as I've got up here, is a period of time. It's from January 1 through January 31, or January 1 through March 31st, or in the case of a year, January 1 through December 31. Of course, monthly and quarterly being a subset of your annual reporting cycle. But most companies close the books. The term there, close the books, meaning zeroing out revenue and expenses on a monthly basis. Of course, they're keeping those cumulative totals for the quarter and for the year. But in essence, income statement accounts are what's called temporary. They're temporary because they're going to be zeroed out. You say, we're zeroed out. Why would you do that? Because they're temporary. And they get zeroed out to what's called income summary, which is another temporary account, which then gets closed out to retained earnings, which is on your balance sheet. That's what the area is out here on the right, showing the income or loss is closed out to the balance sheet as retained earnings. So the next part of this is I've got these normal balances. Normal balances. What is that? Well, some of these things you just have to take at face value. A normal balance for revenue is a credit. Normal balance for expenses is a debit, right? And if you end up with more debit than credit, then what? You got a loss. If you end up more credit, meaning more revenue than expenses, then you have a gain, don't you? And you can see if I've got more revenue than expense, a credit, that's ultimately going to be closed out to retained earnings as what? A credit, because you got to zero out your revenues and expenses, and that's going to show up in your equity as a credit. Credits and equity is a good thing. All right. And the balance sheet here is a point in time. A point in time. That says, well, as of January 31, what are my balances? And these are permanent accounts. Things like cash, accounts receivable, property, plant, and equipment, your accounts payable, your wages payable, your equity, the common stock, your bonds payable. Of course, those go up and down as well, and ultimately could be zeroed out. Maybe not common stock, but your bonds payable are going to be zeroed out at some point. Any of your payables are going to be zeroed out as you pay out cash. Accounts receivable is going to be zeroed out as the cash comes in, but they're permanent. They never get zeroed out. And the only link between the income statement and the balance sheet is retained earnings. All right, so assets equals liabilities plus equity. That's a 6th grade algebra question, right? So if assets have a normal debit balance, and again, take that at face value. If it has a normal debit balance, you go across the equal sign. If debits equal credits, and the equation has to be equal, right? Then liabilities and equity both have to have credit balances. All right, so when we look at a normal credit balance for revenue, a normal debit balance for expenses, normal debit balance for assets is a debit. What do you think expenses and assets have in common? Why do they both have a debit balance? Why are most of the entries a debit when you're making journal entries? Well, what is an asset? By and large, it's an unexpired cost. You know, people use the term cost and price and expense equally, and they're not the same. An unexpired cost is an asset. When you purchase property, plant, and equipment, you debit that asset and you credit cash, right? One asset goes down, the other one goes up. Well, what do you do with that asset? You allocate that cost over its useful life as what? Depreciation expense. So that's what an asset is by and large. Maybe not accounts receivable, but inventory. That's an unexpired asset. What happens to inventory when it's sold? Comes off your balance sheet and goes to your income statement as cost of goods sold, expense, right? You credit your asset, you debit the expense. That's the process. So always remember the normal balance for an asset is a debit and the normal balance for an expense is a debit. It has to be, because as you credit an asset to get it off your books, it goes over here to your income statement. All right. Found down there at the bottom is the statement of cash flows. We'll talk more about that later. Statement of cash flows does not have any accounts. It uses all of the income statement and balance sheet accounts. So there are no accounts associated with that. So when you look at this, and a company may have 10,000 accounts in their chart of accounts for their books, it's one of five. It's either a revenue, an expense, an asset, a liability, or it's equity. One of those five, you've got 10,000 accounts. And a lot of the large companies have a lot of accounts. But this is just the basics of what goes on, the mechanics of what goes on as we go through this book on Accounting Made Simple. So let's go ahead and jump into that. Let me stop the share here. And that way I can just sort of turn around and show you on the screen what I'm looking at. I'm not going to spend a lot of time on this. But let's go ahead and look at what Mr. Piper has to say here. Now I just kind of talked about what he's already mentioned here in the introduction. Here on page 1, the accounting equation. All right, what's these assets equals liabilities plus equity? Very basic, very basic. I think I need my glasses. The type is so large in this. What are assets? All the property owned by the company. Owned. A better term there would be possessed. Not that the company's possessed, but what does the company have possession of? That's what an asset is. It's like you think of it in terms of assets and liabilities and equity in your own life. Now, people talk about net worth all the time. What is net worth? That's equity. That's the same thing. If you're living in a house that's worth $100,000, that's what you paid for it. Well, that's what you're going to pay for it if you still got a mortgage. Let's say $100,000. Let's just say you just bought a $100,000 house a couple of weeks ago, and you put 20% down. So that $100,000 sitting there on your books, 20% down. So you've got what? $80,000 payable liability, and the other $20,000 is what? Equity. So that's just your basic formula that you use in your own personal business or in a company that's got $20 billion in sales a year. Assets are what you possess. Your liabilities are what you owe. Your equity is what you own. Own plus owe is equal to what you possess. Same way with the car. Owner's equity, next page, my asset is your liability. And remember, that's on page 7 of this. Remember, whatever is my asset, if I've got $100,000 of cash in, let's say, Eastman Credit Union, well, you hear talk all the time about they're going to credit your account. Well, they're crediting what? Their liability. My asset of $100,000 is Eastman Credit Union's liability for $100,000. What happened there? When I gave them, I loaned them $100,000, they put it on their books as an asset, $100,000, and then they've got a liability for $100,000 payable to me. So when I get interest each month, then they actually increase their liability, right? Right, for what you have earned in interest. They credit your account. That's a good point there that Michael makes on page 7. And then there's a summary for each of these chapters. Look at the back of page 8, right? read over those. Make sure you understand what's going on. I mean, this is short, very concise. Okay, chapter 2 is about balance sheet. And they got a good example there of a balance sheet. See how they show the assets, the liabilities, and equity. Your 480,000 there has to equal the 480,000 down at the bottom of the page. What you possess is equal to what you owe plus what you own. Current and long term. Why is that important? What is current? Current assets, current liabilities, anything that's called current means it's going to be either turned into cash or paid in cash over the next 1 year, 12 months. That's the operating cycle. You hear that term operating budget in your businesses? Operating means the next 12 months that you're putting together your plan. And usually you got a capital project, capital expenditure plan going alongside at the same time you're doing your operating plan. Operating plan is your revenues and expenses. Capital plan is how much cash are you going to spend in your future property, plant, and equipment. The current versus long term, it's important for solvency. You know, your current ratio is your current assets divided by current liabilities. Should have more current assets, you have current liabilities, or else you have what? A solvency problem, a liquidity problem. Oftentimes you see comparative balance sheets over time showing 1 year versus another year, what's changed. We'll get into all of this later on when we get into the MBA fundamentals. But this is a great start. This is a great start to make sure you know where you're at in regard to accounting without reading a textbook that's got 700 pages from accounting principles. All right, chapter 3 is the income statement. All right, I've already talked about that a little bit. You can see the sort of a layout there on page 19. Revenues minus operating expenses. There's a lot of different formats for income statements, and we'll get into that depending on what type of a company that you're working for. Simple summary there on page 20, statement of retained earnings. Now that's a statement that I didn't mention a minute ago because it's sort of a subset of what we're talking about. You really need to understand income statements and balance sheets more so than statement of retained earnings. What did I say about retained earnings? That's the link between the income statement and the balance sheet. That's where revenues and expenses are zeroed out to retained earnings. Now it gets zeroed out through income summary, but ultimately revenues and expenses are zeroed out to retained earnings. And so if you got more revenues than you got expenses, then you got what? More credit than you got debit, which ultimately is going to mean a credit to retained earnings. And that's a good thing. That's what is retained earnings. That's what you own, right? That's driving your business. All right. Dividends on page 25. We'll get into more of this in this other text as well, or other book. Dividends are not an expense. What does it take to pay out cash dividends? Two things: retained earnings and cash, right? It's not an expense. Retained earnings is reduced into dividends payable, and then dividends payable is zeroed out to cash. Retained earnings is not the same as cash. It is not. That's just the accounting accrual basis of what your income is. It's what the cash flow statement does. The cash flow statement, in essence, takes your net income, which is based on the accrual base of accounting, and converts it back to the cash basis. And that's what chapter 5 is about, the cash flow statement. I can't get used to it. Everything's the opposite. Looking at the screen, the way I got to move my arms. Statement of cash flow is important because most times people who are non-financial will say, well, what happened to my cash for this period, for this month, or this year? Let's say I made $1 million net income, but my cash is the same balance as it was. Why is that? And there's several things can happen, or several things can occur to make that happen like that. And if you look on page 29, the statement of cash flows is based on 3 areas: your operating, your investing, and your financing. 3 areas. That's where you drill down and show what happened to my cash year over year or month over month. If I made $1 million, why did I not have any more cash than I had when I started the period? Well, the operating section tells you how much did your core business drive through your net income? Of course, that's taking your accrual-based net income and converting it back to cash basis. The second one there is your investing. Well, that's where a lot of your cash goes, because that's when you invest in property, plant, and equipment. You reduce cash and increase your other assets. That's the big reason that that $1 million in net income is actually showing zero increase in cash. You spent the cash on property, plant, and equipment, or pay down of your liabilities, long-term liabilities if it's investing. And then the third category is your financing. Your financing. What is finance? That's when you sell bonds or receive a note payable, receive the cash and you got a note payable, or you sell stock, preferred or common. Cash comes in and your liability goes up or your equity goes up. Of course, that's going to make your $1 million go up even more from financing. So that's what the statement of cash flow does. It breaks down what happened to your cash between operations, investing, and financing, OIF. All right, and they show a good example of that there on page 31. Operating, investing, financing. Chapter 6 is about financial ratios. You know, I talked about this liquidity ratio just a minute ago. That's one everybody always talks about. Down at the bottom of page 30, I'll never get the hang of this. 33, current assets divided by current liabilities, meaning what am I going to turn into cash over the next 1 year? Like accounts receivable and inventory, you know what your cash balance is, but what else is going to be turned into cash that is a current asset? Inventory, accounts receivable primarily. And then what am I going to have to pay out, which is accounts payable, wages payable, income tax payable, all those payables. Do I have enough cash equivalents to pay that off? Quick ratio on the next page. There's a lot of different things here you can read on your own. Profitability ratios, return on assets, return on equity on page 36 and 37. Leverage ratios on page 39. What's your liabilities divided by assets, right? How much debt do you have for what you possess? How much do you owe on what you possess? And debt to equity ratio, asset turnover ratios. Inventory turnover on page 41, how important that is. Inventory turnover. Cost of goods sold divided by your average inventory. Cost of goods sold, again, is an expense. Doesn't say expense, but it's cost of goods sold expense. That's when your inventory comes off your books as a balance sheet item and goes to your income statement. Right? We had some $24 million of inventory any given time at Exide in batteries and so forth. And once that came off those racks and got put on a truck and was sold, recognize the revenue. You recognize the revenue and then you recognize or match the expense with that. Well, the expense is your cost to get sold. That's the process. But the question is inventory turnover is how many times a year do you turn your inventory over? The higher the number, the better, right? If you got an inventory turnover of 6, that means your inventory is staying there a long time. Well, how many days is that? And it's got that in days here somewhere. Inventory period. What's 365 divided by 6? 60 days, roughly. 365 divided by 6 is about 60. So that's saying something you've got out there on your racks is sitting in your racks for 60 days before it's sold. Well, what if your inventory turnover was 12? Then your number of days in inventory is 30-some. That's a lot better because you don't want to have a lot of inventory just sitting out there on your racks, right? And so that's a big part of why you want to use these ratios to manage your business. Then there's a summary on page 43. Then chapter 7 on page 45. All right, what is GAAP? Generally accepted accounting principles. Very important. Everybody, every level in your company needs to understand that. And the more you understand stuff like this, if you're a non-financial person, the higher up you're going to go if you understand the numbers and why a company does the things it does. Who's required to follow GAAP? All publicly traded companies. Now, some mom and pop doesn't have to. Some mom and pop store that's just, you do whatever you want. If you're not publicly traded, you can be on the cash basis. A lot of them do that because that's what they do for their income tax. So you don't care about the accrual base of accounting. See it a lot here in the Tri-Cities, small companies, people that work for them say accrual, what does that mean? All right, in chapter 8, that's a short chapter, wasn't it? 2 pages for GAAP. And so now in debits and credits, what is a debit and a credit? Well, debits and credits must be equal. That's why I showed those T accounts with the debit side, right? The left side is the debit side and the right side is the credit. A T account, it has to balance, right? It has to balance. Assets must equal liabilities plus equity. And so you need to understand, why do they have the normal balance that they do? The assets and the expenses, first of all. So fundamental. Those are siblings. Even though expenses are temporary accounts, assets are permanent accounts, they still are intertwined. But read this chapter on debits and credits, very important. They start showing you what some of the transactions are for this. The general ledger. You know, when we talk about what goes on in the accounting cycle, there's a general journal. When you're making journal entries like what's shown here, those are journal entries. And when you see like debit rent expense, they use DR, 4,500 credit cash. That's a payment for $4,500. When they're showing debits and credits like that, the 4,500 on the left, that means it's a debit. The 4,500 on the right means it's a credit. They're showing it just in the general journal, these transactions, like a journal of your business. Once you journalize these transactions in your business, whether it's making a payment or if it's just making an estimate under the accrual basis of accounting, once those are journalized, then they are posted to the general ledger, which has your income statement and balance sheet accounts. And that shows what your balances are. And that's what they're showing there on the bottom of page 53. All right. They talk about T accounts. I was controller for many years, and I always used T accounts because it was so easy to follow in graph form exactly what's taking place there. And so you can see on the left side of cash, those are debits, those are increases in cash. The 200 and the 950 on the right side is a credit, a reduction of cash. So you can draw a line under there and show what your balance is, just like they're showing $850, right? Down there at the bottom of the page. I don't think you can see that. It gets blurry, doesn't it? Well, you got it there in front of you, so that shows your ending balance is $850 for inventory. And then a trial balance is nothing more than, because you'll hear that term as well from your accounting folk. The trial balance is nothing more than just printing out from your financial system. What's the balance of your revenues, your expenses, your assets, your liabilities, and equity, all 5. Even though you may have 10,000 accounts, what's the balance? And when you get to the bottom, all your debits must equal your credits, or else you got a problem, right? You've got a one-sided entry. All right, chapter 9 is about cash versus accrual basis. The accrual basis is all about that revenue recognition and expense recognition. Recognize your revenue, match your expenses to that revenue, right? That's the core business of what your accountants are doing. It's not that complicated. But the accrual basis is based on, as it shows on 59, what has been incurred versus what? Cash basis. So what's been incurred? And they're showing commission expense there, aren't they? Commission expense of $93,000, commission payable. Doesn't mean they have paid it out, but those commissions have been earned in that period, even though it's going to be paid out a week or so after the end of the month. You got to recognize that payable to your salespeople when it actually was earned. The revenue was earned. Of course, this is expense that needs to be recognized against that or matched against that revenue, right? Matching the expense, commission expense with the revenue recognized in the period in which it was earned. Right, that's a great example there. And then it shows the commission payable there. The guy comes out of commission payable or zero out commission payable and comes out of cash when it's actually paid. But that payable is there as a liability as of the end of the month. All right, same way with accounts receivable and sales. You're going to recognize sales when it was sold, when those performance obligations were met. You recognize the sales and you put it on your books as accounts receivable. And then when you actually receive the cash, then you credit accounts receivable and debit cash, right? Top of the page. Do you love this book? All right. What's a prepaid expense? You know, that's when you have something like maybe a lease. You have to pay for a year, but you want to recognize a certain portion of that lease every month during the year, matching monthly that lease expense with your revenue. So what you do is you put that into a prepaid expense and then take it out of the prepaid in 12 equal installments as it's earned. Or you want to recognize the expense as your revenue is earned from that lease. What is unearned revenue? Again, that's the other side of, take Bristol Raceway, for example. They used to have, people would buy season tickets and they would bill you right after the race was held, like in April, they would bill you within a week, wanting payment within 30 days for next year's race. I don't know if they still do that, but they used to. Well, anytime you would actually pay them, say $600 for 6 tickets for next year's race, that would go on their books. I mean, part of Speedway Motorsports being publicly traded, that would go on their books as a debit to cash and a credit to unearned revenue, which is a liability account. I know it says unearned revenue, you think, well, that's income statement. It's not. They can't recognize that revenue until the performance obligation is met, until they have earned it. So that goes on their books as a debit to cash because they receive the $600 cash, and then they would make the corresponding credit to a liability, unearned revenue. Then when the race is held next year, they would debit unearned revenue and credit what? Race revenue or race ticket revenue. Because the performance obligation has not been met, the race has not been held, or else they would, if they had to not have the race, they would have to refund the money. All right, the accounting close process. There's always a process every month, closing the books, closing journal entries. I'll let you read through that on your own. Pretty short. They use an account title that I've mentioned, income summary, to zero out sort of the holding tank when you zero out your revenues and zero out your expenses, but ultimately income summary is zeroed out too to retain earnings. So that's like this an intermediate step before you impact your retained earnings. Just always remember, you are zeroing out revenues and expenses to retain earnings. And if you've got more revenue than expense, then that's going to be a credit to retain earnings. All right, other GAAP concepts and assumptions, that kind of goes along with what I've talked about in that PDF. Historical costs, that's the cost principle. Materiality, you know, I talked about the $2,000 threshold for capital, the less than $500 invoices that weren't important for us at Exide. Matching principle, see, they've got fewer than I've got. What they leave out there, they don't have revenue recognition. I don't know why that is. But again, that's just another summary of that chapter on other GAAP concepts and assumptions. All right, so now we're up to page 76, and we are getting through this, aren't we? What we got here, about 96 pages? Well, good. Depreciation of fixed assets. Fixed assets, another title for that is property, plant, and equipment. And that's where you take your cash and invest in your fixed assets. Property, plant, and equipment. Because what's the whole point of having your assets? To drive revenue. That's your revenue stream, usually, especially in manufacturing, maybe not so much in a service-oriented company, but you still have to have offices and so forth and infrastructure. But that's depreciation, is the allocation of that investment over its useful life. So in essence, you're taking that unexpired cost, which is what an asset is, and allocating it through depreciation expense against the revenue that you're recognizing. See how simple that is? What depreciation is, the allocation. Amortization, if you're a company that has a lot of intangibles like patents and copyrights, Eastman would be a great example of a lot of patents. They have amortization expense that they record. Amortization is the allocation of an intangible. Because even though it's a piece of paper, that patent or copyright or whatever, it's really not something that you can grab a hold of. It is an intangible. Of course, there's gain and losses on sales potentially that could occur. You can read about that on page 80. Depreciation methods. You know, every company I've worked for, have done work for, everybody uses straight line depreciation. It's whatever your asset is. If it's a $10,000 asset that's going to last 10 years, 10,000 divided by 10, it's $1,000 a year. You're going to divide that by 12, you can figure out what that is per month. There's a lot of accelerated depreciation and other methods you can use, but you would use accelerated depreciation for tax purposes. That's why you typically have a difference when your tax basis and your book basis on your assets. So when you hear terms like tax depreciation, you're accelerating the depreciation, meaning you take more depreciation in the early years, which typically kind of goes along with what happens if it's a car or a vehicle, right? It's more depreciation in the beginning than lower toward the end. The IRS allows you to use what's called a MACRS, M-A-C-R-S, Modified Accelerated Cost Recovery System. They allow accelerated depreciation, meaning you're pushing the tax out. Over time, the depreciation is the same. But they allow, IRS allows you to accelerate that depreciation for tax savings. And most companies do that. But from a book standpoint, accrual basis of accounting, book accounting, they use straight line pretty much. I've never known a company that didn't. Not to say there's not, your company doesn't, but it's unusual. All right, they do have amortization of intangible assets. It's been a while since I've read this book. So amortization, that's just another way that you're allocating an intangible over its useful life. Just like depreciation is associated with a fixed asset. Fixed asset is something you can physically see. And then we get into chapter 14 on inventory and cost of goods sold. If you're in a manufacturing or merchandising environment, very important. Again, inventory is on your books as a balance sheet item. And when it's sold, whether it's something that you purchased and then resold, like a clothing store, or if it's something that you've manufactured and then sold, it's coming off your books as an asset in inventory and goes to your income statement as an expense. Physical inventories, you probably hear a lot about that at various companies. They talk about a perpetual system here versus a periodic. Perpetual is usually you have a software system that allows you to maintain balances of your inventory as you buy and sell. We did that at Exide. Most companies do that. Clothing stores, you know, when you check out, they have a barcode that probably is on their books as an asset. Now, I know there are grocery stores. There's a large grocery store in the area that, you know, you check out and you hear all the beeps going off for what it costs. But I found out that actually is not an inventory system. That is nothing more than a sales price. So that barcode has nothing but a sales price associated with it. They don't keep up with inventory. How they keep up with inventory is they actually do a periodic inventory every so often, depending on what part of the store they're in. They do a periodic, which another term for that is a physical inventory, meaning they actually go out there and count. Maybe they do it at 1 or 2 a.m. when nobody's in there in a store. But they do that, and then they figure out the difference between what were their purchases and what their inventory was. And the difference is what they book as cost of goods sold. Now, it works for them because they're very successful, but most companies don't do that. Most are going to have a perpetual system that tracks their inventory level at all times and all processes. If you have a cost accounting system, you have to do that. But if you're in the grocery business or something like that, I don't know what Walmart does, but they're more concerned about what's the price of these items, more so than theft or keeping up with because they're just buying and reselling is all they're doing, buying and reselling. So that's why they just focus on what the price is. It's a periodic method. You know, even though we had a perpetual system at Exide, we had one at Lear to track inventory and production and assign our costs to the product. Once a year, we would have a physical inventory. We stopped production and spent a couple of days. It took a lot of time, a lot of effort, a lot of expense to actually count what our inventory should be, because we had inventory balances based on all the production, all the scrap reporting, all the receipts, all the shipping. And that was just a verification that our inventory processes were in control. PwC at Exide used that as really a great, it put a lot of weight on whether Exide's books were fairly stated based on these physical inventories. And if you had a good physical inventory, I mean, you didn't lose much dollar-wise, they consider you were in control of your company. So it's very important to have a periodic that verifies your perpetual system. But then again, some people who don't have a perpetual, they just rely on the physical or the periodic, same thing, to manage their inventory. All right, there's another inventory method. They talk about first in, first out, last in, first out. Most companies I've dealt with use the standard cost system. They call it average cost there on page 93. That's a whole nother topic, the whole costing side. But that gets us through this book. Of course, the last couple of pages about what? Humility. You don't see that very often in a book, do you? The humble little journal entry. When do you make a journal entry? When do you not? We'll get into more of that later, but that's just sort of an overview of the accounting process. Everything you want to know about accounting, but we're afraid to ask. So that's it for week 1, I believe. Yes, so next week we'll look at the revenue recognition case, and we'll jump into the MBA fundamentals of accounting and finance, and we'll look at, looks like we're going to be looking at the first 4 chapters over the next 3 weeks. So I'll decide how we sort of split that up as we go, but we'll talk to you soon.